Good morning and welcome to this Monday, November 8th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, last week was something. We talked about historically the October 27th close through the November 5th close being the strongest period of the year. And we saw the market going up pretty much every day. It was another testament to why we study history, why we keep track of history. Doesn't always work, but it's at least one tool that we at least need to be aware of as we approach the market, trying to figure out which way it's likely to go. Really, the next couple of weeks tends to be pretty flat, not, just kind of boring. Most months, the November, December months are a little different than the months the rest of the year. The rest of the year is pretty consistent in that you usually start the month off well, then you have a period of profit taking, then you have a little bit lesser of a bullish advance, but money flows come in middle of the month, so you have another one of those runs, and then you go into options expiration. You tend to struggle from the 19th to the 25th, and then you usually finish the month pretty strong. That's kind of the blueprint for what we expect historically throughout most of the months. November and December are both a little different, especially December, but November is as well. November starts off really strong, just like the other months. In fact, like I mentioned, it is the strongest period of the year, October 27th close through November 5th. But the 6th, you don't really get a little bit of profit taking, but not a lot. And it's really from the 6th until about the 20th that the market just kind of flounders. And then we pick back up again as we get into the holidays. So normally that 19th to 25th period is not a very good period of the month. In fact, it's the worst if you look at all the months. And this dates back to 1950. But in November, things are a little bit different. Anyway, just wanted to point that out as we look out, because we still have another 3.5 weeks of November to deal with. Overall, I'd say that the market tends to be pretty bullish in the month of November. So I wouldn't be looking for anything major to the downside, but I wouldn't be surprised if we get a little bit of choppy action. We'll see. And that especially is going to be true if value stocks begin to perform better versus growth. We've seen yields coming down. That's helped growth stocks, and I think that could change. Anyway, we're going to get into all of that and more, much more. But first, for those of you who are new to Earnings Beats, I always like to start the show just to let you know what we have available. If you go over to earningsbeats.com and then simply just scroll down here, you'll see there's an area where you can sign up for our free Earnings Beats Digest newsletter. All it takes is name, email, address. This is completely free. There's no credit card required. Hit that subscribe button and then we'll get you set up. It's a 3 times a week newsletter. It's a very, very brief read. So don't worry, it's not like a 5 or 6 page document. It literally is a chart in 2 paragraphs usually. So if you're interested, we'd love to have you. Again, name, email, address, that'll get you set up. All right. Also, we've got a lot of events coming up. It is November, and I'm just going to mention too, later this week, we are going to be offering our fall special, and we're going to top ourselves this year in terms of our special. So tune in, just, be focused, because we're going to have this coming out here in the next couple of days. But it is going to be a very, very good offer. I think the best one we've ever offered for committed membership, meaning a year or possibly more. Anyhow, that's your little hint. But we do have events coming up this week. We've got our earnings reaction portfolio draft on Wednesday evening. That's really important, because this is the second quarter now that we don't even have this on our website. If you look for historical performance, you'll see we have the model, aggressive income, and strong AD portfolios, which historically over time have all done pretty well. Income's trailed a little bit, but a lot of times income, you're looking at dividend payers. And I can just tell you that since, for the most part, since the bull market began, it's been more about growth than it has been about value and dividend or, dividend paying stocks. So it's not surprising that, if you're trying to put together a portfolio of dividend payers, it's going to be a little bit it's going to be difficult to outperform the S&P 500 because that's being driven by growth stocks. I mean, just look at the growth versus value ratio over the last 8 years. I mean, it's been going straight up. So again, if you're into dividend payers, mostly, you're going to have problems keeping up with the S&P 500. And I think that's been proven true in our portfolio as well. But the other three, since inception, have really crushed the S&P 500. And that's not easy to do when you're equal weighting 10 stocks in each portfolio and doing it every quarter over a long period of time. But you can see the results speak for themselves. We also have an ETF portfolio. I can tell you this one's challenging just because I don't pick the stocks. I have to pick ETFs, which then pick the stocks. So I don't have any hand in and it's very, very widely diversified. So anytime you get a really diversified portfolio, it's hard to beat a diversified S&P 500 index, especially one that's being led by Apple and Microsoft, Google, and some of the, Tesla and some of those big names, NVIDIA. If you don't have those stocks in your, heavily weighted in your portfolios, you're going to struggle to outperform. But still, this quarter, based on the themes that we talked about, this was back on October 19th when we selected the latest model ETF portfolio. You can see this quarter has actually done extremely well, 644 versus 394. Anyhow, we do have this earnings reaction portfolio draft coming up on Wednesday. You don't see that portfolio here because this is our first quarter. We're actually just trying something new. I can tell you, we led for most of the quarter. We started off weak, then we came back, took the lead. We were beating the S&P 500 with this portfolio. And then literally last week, I think the S&P was up 2%. This was down 2%. And so the earnings reaction portfolio is about even with the S&P 500 right now with 3 days left, today, Tuesday, and Wednesday, to try to take over and outperform the S&P. But we're going to do it a second time. I think it's still very worthy. And what this earnings reaction portfolio is it's companies. What we're doing is we're looking at companies who had the best days after earnings, and we're ranking them. Doesn't mean top one is necessarily going to get picked for the earnings reaction portfolio, but we're starting at the top and we're looking at the opening price versus the closing price the day after earnings are released. So if you release on a Monday, let's say you release tonight after the bell, then I'm looking at what the stock does from the opening bell on Tuesday to the closing bell and calculating that percentage, the close over the open. And highest percentages we're going to rank in order, and we're going to start going down the list and picking the 10 stocks that we want to represent that earnings reaction portfolio. Anyway, that's coming up Wednesday. We've got our draft for all of our portfolios. It's going to be a little different this year or this quarter, because November 19th ends on a Friday. And so I was thinking, all right, we're going to do a Friday night draft. No, Sunday, I actually am busy, so I can't do Sunday. So what we're actually going to do is we're going to do it on Thursday, but we're going to do it later in the evening on Thursday. So I have time to look at Thursday evening earnings reports to see if I want to include any of those in. So what that'll do is we don't actually buy the stocks until the Friday close. So even though we're picking them on Thursday, that gives everybody the opportunity to get in at the price that we're going to get in at, or maybe you'll get a better price. Who knows? Anyhow, just wanted to mention that we got that event coming up. We've got a sneak preview for that coming up. We've got, all kinds of events, and we'll keep you posted on all those. And you can check out our event calendar at our website as well. Anyway, all right, that was a lot of chatting, but let's get on to what happened on Friday. Dow Jones up about 0.5%, S&P 500 1/3 of 1%, NASDAQ 1/5 of 1%. All three finished higher, all three in record high territory. Mid caps up almost 1%, about 0.9 of 1%. Small caps up more than 2%. Small caps have just taken off. And that's generally what happens when you get a breakout. We saw it with the consumer discretionary group recently, the XLY. When it broke out, it just exploded to the upside, like 12, 13% in a month. Actually, I think the last month, the XLY has been up 17%, something like that. So you got to, be ready, be watching, especially when you get these long bases like we saw with the mid caps, the small caps. You finally get that breakout and you get a lot of money rotating into those areas. So small caps led last week. They led on Friday with a gain of more than 2%. Very solid action there. As far as the sectors go, energy led on Friday. Energy has been kind of struggling here of late, but it was one of the top performers. Utility, which had been struggling late, the utilities group, also one of the top performers. Industrials, this is a group that I'm very high on right now. I mean, I don't know if I could have talked any more about their seasonal strength during the month of November than I did. I've been talking about it for weeks and weeks about how industrials love the month of November. They've outperformed the S&P 500 something crazy like last 13 years or 13 last 14 years. This is the month industrials tend to shine. We just got a breakout on industrials. Been trying to get through this 10. I'll go ahead and just pull this up and show you. Been trying to get through this 106 level. Multiple occasions. We just did it on Friday. Just broke out. You've got railroads cruising. You've got truckers on a roll. Even airlines picked it up late last week. So I think we've got transports leading. We had the transportation index breakout, which is part of that Dow theory. So when you get the Dow Jones breaking out to an all-time high, and you also get the Dow Jones transports breaking out to an all-time high, they confirm one another. That's very, very bullish market action. All right. So just want to point out, make sure you're aware, XLI breaking out. Utilities also had a nice day, up almost 1%. Communication services, which has really been struggling, need to get through that 82.50 level. As I said last week, I really believe the low is probably in at about 79. I don't think we go back down below there. This is a group that was leading all the way up to that early September high and then took a couple months off. I mean, we've seen rotation everywhere. Well, it was communication services time, September and October. Now we're into November. It looks like we're trying to get back up through resistance, but we still have to confirm that, make that move. Worst performing group last week, healthcare. Healthcare last week got up close to their the top, that double top we saw in August, September. Couldn't quite get all the way up there. Looks a little bit like a cup, maybe with a handle forming down to the 20-day. Didn't quite get up. I like to see a cup get all the way up, at least equal, maybe even a slight breakout, and then come down and put that handle in. So this one fell a little bit short. Just you got to be careful with this cup that you don't tip it a little bit in the front. You spill half your drink out. That's not the way you really want to see a cup. You want to see a cup all the way up to the top. Anyhow, this pullback, not out of the ordinary after a move up in the healthcare space, but I'd like to see these moving averages hold. Friday, when I get to the three you must see at the end of the show, I'm going to feature 3 healthcare stocks. Friday just was not a good day. You can see down more than 1%. And really the end of the week was not good. Thursday and Friday, when Pfizer came out with their news about their COVID-19 pill, and then Moderna came out, missed their earnings estimate, missed their revenue estimate, and then also lowered their guidance going forward, and then got hit by the Pfizer news on Friday. I mean, it was part of that is what was triggering some of the selling in healthcare. All right, moving on, 10-year Treasury yield. As far as earnings go, economic news goes, this is a very, very light week. Tomorrow we have the PPI. Wednesday we have CPI and jobless claims. Normally we get jobless claims on Thursday, but they'll be out on Wednesday this week because Veterans Day is Thursday. So we've got PPI on Tuesday, CPI and jobless claims on Wednesday, Friday, consumer sentiment. So that's it in terms of economic reports. Earnings reports will still be pouring in, but it's more the second and third tier companies. So we've gotten most of the big companies out of the way. We do have companies like Applied Materials. That's a big name in the semi space. Applied Materials just broke out last week. So we got a lot of that going on. But in terms of economic news and what might happen here with the 10-year Treasury yield, we're going to have to kind of wait and see. But right now, currently we've been pulling back. We had a big down week in the yield last week, which led to a lot of the growth stocks performing well. I was saying, I thought it would hold the 50-day, but there is this yield support down here at about 138. I think the further this yield goes down, the more and more the bond market and the stock market are screaming that inflation is not a problem. But we've got PPI and CPI coming out the next 2 days, and both are expected to tick up from last month. So tomorrow morning, PPI is expected to come in at 0.6%, rise of 0.6%. September was rise of 0.5%. Core is expected to rise 0.4%. In September, the core rose 0.2%. So I'm just pointing this out because sometimes when you have very little in the way of economic news coming out, and you have not a whole lot of big companies reporting earnings, sometimes the focus shifts. And if all of a sudden the focus starts talking about inflation again, we could see a period of some selling. A lot of these growth stocks like Nvidia, Tesla, these stocks have been flying. AMD, a lot of the semiconductor group, it was a huge week for semiconductors. Some of these companies might take a backseat if we start seeing more headlines on inflation again. But all I can tell you is what I'm seeing from the charts, from both the bond market and the stock market, inflation is not going to be a problem. It is a temporary problem because of the imbalance in demand versus supply, given all the supply chain issues, given restrictions being lifted, more people out, everybody wants to spend money on something. And so you've got this crazy imbalance that I think is going to reverse back the other way in 2022 to a degree. And I'll be talking about that more as we get closer to year end. I'm still doing a lot of research, looking at things, but I think 2022 could be rocky, much more volatile than what we've seen in 2021. We've seen mostly a market that's been going higher. I think that could change in 2022, but we'll talk about that more as we get closer to year end. And I'll definitely be talking about it in Market Vision 2022, which we always have a special event beginning of the year where we look throughout the year, do some forecasting. That'll be coming up early January, and you can bet there's going to be a lot of discussion in that event. All right, so let's move on. I want to talk a little bit about the DAX, the German DAX, because we pointed out the various global markets last week during one of my shows. And we talked about the German DAX getting up here close to the 16,000 level. Well, on Friday, we closed over it. First time in history, the German DAX broke out to an all-time high on Friday. That's good news because there is no global index, foreign index, that is more positively correlated to the S&P 500 than Germany. I mean, I'm not making this stuff up. We could pull it up. I pulled it up last week. But the correlation is strongest between Germany and the US, much more so than China. So when you hear all these stories about how China's doing this or that and how that's going to impact the US, take a look at the charts, because the charts tell you it's not about China and the US, it's about Germany and the US. Anyway, Germany breaking out, I find that to be bullish. Although it was down fractionally, I think it was down about 0.15% earlier when I was looking at it today. But I mean, even after getting a breakout, we could pull back and fail to hold the breakout level. Sometimes you get these head fakes. What I'd be watching is this rising 20-day, which has been holding in Germany. I fully expect it's going to hold on any pullback. So I love this index. The problem is, you've got a dollar component. If you trade something like the EWG, you got to be aware of what the currency does to your investment in EWG. And we'll save that. That'll be a discussion for another day. I do talk about that every once in a while, but you always, when you're investing in any of these ETFs that track a foreign index, you have to understand that there's a dollar component. There's a currency component that you have to be aware of. All right, S&P 500. I thought what we would do here is just talk a little bit about these 60-minute charts, because remember, I wrote an article probably 2 or 3 weeks ago, and I was actually turning a little bit bearish in the short term, because everywhere I looked, I was seeing negative divergences. You can see this, the 21st, 22nd of October, and that's when we were going into a historical bearish period, the worst of the year. And as we were doing so, we were breaking out to new highs with negative divergences, lower PPOs on the 60-minute charts. And it wasn't just our major indices. It was all the key stocks that, were leading the market, Tesla, Nvidia, AMD. It was just across the board, Apple, Microsoft. I could bring up Microsoft and show you the chart. there. I mean, you see, as we were moving up higher here, see that PPO coming down? Well, guess what? Even though we didn't have a big sell-off, we did go sideways and we brought that PPO back down near the center line. We got the 50-hour SMA test. That's all we look for. So, you know, at the time, I wasn't calling for a bear market. I was just calling for, hey, this, you got to be a little careful. History tells us we got to be careful, and then all these negative divergences. But by the time the 26th, 27th rolled around, you can see the end of the 27th, the S&P came down and just about hit that 50 hour. And from there, we've been going right back up again, and you can see the PPO rising. But on the selling on Friday, that PPO started to get hit a little bit harder. And so I think if we get any kind of strength this morning and get a breakout, we could begin to see some negative divergences. I think we're going to run into some headwinds this week after a great start to November. I feel like you're probably going to go up to one more high and then maybe pause for a little while, maybe until we get toward the end of, closer toward the end of November. Maybe we go sideways for a bit. I'm just speculating. I mean, we're going to follow the charts and keep you posted, but it just kind of feels like it's setting up like that to me. I mean, we've made a huge run back at the beginning of October, 4,300 to 4,700. That's almost a 10% move just here in this last month. So again, it's just unreasonable to expect that the market's just going to keep going up 10% every month. It's not going to happen. So, got those bullish. I still have my a lot of folks probably think I'm a perma bull. I'm not a perma bull. I'm going to be bullish much more often than I'm bearish, but I just don't see any signs to be bearish. All the signs are pointing bullish. So I remain bullish, but that doesn't mean we can't have a period of profit taking, a period of consolidation. And I wouldn't be surprised if we see some of that. As we're getting through the earnings season, got a lot of great earnings reports have come out, a lot of great reactions, market going higher. It just seems like maybe we'll pause, but we'll see. All right, moving on, I want to talk a little bit about sector rotation briefly. Here on this chart, and I was going through this weekend, so that's why I wanted to bring it up. Technology relative to the S&P 500 broke out last week to a new all-time high. It's a secular bull market. You cannot ever count out technology in a secular bull market. You'll go through periods, and I tell you, back in February through May, when all that talk about these huge spikes in inflation, growth stocks get hit when there's an inflation scare. And so that's exactly what happened here. But if they start talking about inflation again in the media, just remember, technology just broke out to an all-time high. Wall Street would be selling technology hand over fist if they believed inflation was going to be a problem. Instead, it's breaking out to an all-time high. So you decide if you want to follow media reports or if you want to follow what Wall Street's, where they're putting their money. Consumer discretionary exploded. I mean, I wrote many articles about this, but we had come back and we had tested this relative support area. We had a relative wedge that we had just broken out of right before we went into October. We hit this PPO relative support down here at -1. The only time we've seen it go down below -1 was back here in 2008 during the financial crisis, which is kind of an exception. For the most part, when we get rotation out of consumer discretionary and that PPO moves to -1, historically, that's been when we've taken off, and we did it again. Consumer discretionary has been killing the market and the overall S&P 500 since we put in this -1. And I wrote articles, talked about it on here, talked about it in the daily market report for our members. It's not that we knew for sure. It's all about probabilities and odds. That's what technical analysis is about. It's about managing risk. When you're flying high in consumer discretionary, you have to realize that when you're jumping in at that point, you're probably jumping in with a lot more risk because the group has already made such a huge run. It needs a break. Here, we're just making the breakout. So we've seen this before. We just made the breakout here. Look how much longer we led. Here, we made the breakout. It was another 9 months of leadership here. So I don't think this is stopping anytime soon, by the way. I don't think we're too stretched at this point, but maybe in another 3 to 6 months, this keeps going up. We'll probably be at a point where you want to lighten up on consumer discretionary. And I'm just going to go through the aggressive groups here because we still got some other things to go through. But this is what I was talking about. Communication services took a break. So look at this relative PPO now on the XLC, -1. Where have we turned in the past? Well, 2015 and 2018, we both turned right around -1. So communication services started to show some strength last week. Maybe this is it. On an absolute basis, you can see communication services starting to hook back up to the upside after a nice little period of profit taking. So this is a group that you might want to continue or start looking in. Industrials, I think, also at that -1 level where we've seen a lot of turns, but industrials just made the breakout. I don't know why this is coming up with technology, but I have to go back and change my charts. But anyway, the XLI, let me just change it here so that we can see this. Hit save. All right, so here you can see sideways consolidation. Well, the S&P kept going higher. So on a relative basis, industrials were dropping. Well, now that we've made the breakout, I mean, you can see when we're trending higher, we tend to outperform. It's when we go through these periods of consolidation or choppiness, that's when industrials tend to underperform. But when they're breaking out and moving higher, this is kind of an idea. See how we came off a -1, then we made the breakout, then the relative strength picked up. Well, here we're -1, we're making the breakout, and I'm looking for relative strength to start picking up on the XLI. The last one I'll show you here is just financials. These are the 5 aggressive groups I like to keep an eye on. I mean, financials got hurt, but you're going to get hurt in financials on a relative basis anytime the yield's coming back down. I don't think the yield's going to go way down. I think the yield's going to probably consolidate. I still wouldn't be surprised to see the yield make a run for 175, the 10-year Treasury yield. If that happens, you'll see financials pick back up again. If we continue, if the reports next couple of days with these inflation numbers coming out, if they're weaker than expected, I wouldn't be surprised to see the 10-year Treasury yield back in the 130s, 138, 139. And you would probably see financials continue to perform poorly on a relative basis. So a lot of it in the short term will hinge on those inflation reports on Tuesday and Wednesday, and then also the market's reaction over these next couple of trading days. All right, earnings spotlight. I just wanted to point out Trade Desk came out this morning. You can see that reaction. That was as of, well, right before we started the show. So let me give you an update here. Market opening in 3 minutes. 22% move to the upside. Now, 83.89. I don't know where it's going to open. I'm going to pull this chart up, though, because this is an interesting chart. We got this high over here. Obviously, we got this high over here at 97. It doesn't look like we're going to break out at the open. That always makes me a little nervous. So we may jump up. If we jump up into this 83, 85 area at the open, and then we move higher and it looks like we're breaking out above August, I would be very careful if it comes back down and fails. If we get a false breakout and we come back down, chances are we'll probably go sideways and it'll be more of a head fake in the near term. Trade Desk has been a great company for a long time, but it's kind of got that almost like that Amazon feel to it, where it just went up so much. It needs to consolidate for an extended period of time because of how far it ran. Everybody's getting all, tired of Amazon, but look at the move. Amazon went from 1,600 to 3,600 in about 6 months after the pandemic. That's a major move. And so all it's been doing is consolidating. I still love Amazon, but I can't tell you if it's going to break out this month or maybe in February of next year. I'm not sure when it's going to break out, but I believe this is still in a bullish pattern. And I think our break is going to be the upside, not the downside. But that's kind of what Trade Desk is doing as well right now. It's just struggling and trading sideways mostly because of, that huge run up previously. One other stock that I'll show you that COTY, they beat, and by the way, Trade Desk beat 18 cents versus 16 cents. COTY beat 8 cents versus 3 cents, and it is up over 8% today. So this one looks like it's going to try to clear all of this overhead resistance. If it opens above it, it has a better chance, in my view, that it will continue to go higher. All right, let's wrap it up. And by the way, later today, we've got PayPal coming up, AMC Entertainment. They're going to be out later today. Five9 FIVN. Remember, they were going to merge with Zoom, and then they called that deal off. Well, Five9 reports today. So those are three after the bell you may want to keep in mind. So the three you must see, the three I'm going to look at. First, Moderna. Moderna took a big hit here last couple of days. Market just opened, so I'll give you a quick update on where we are. Well, it's not going to show me. Try one more time, see if we get an update on Moderna. There we go. So right now it's down $3. Did print a hammer on Friday, so I'm thinking maybe it'll move up today. I was looking maybe for a gap up and leave this on an island. We didn't get that. So in my opinion, it's not as bullish now as it was at the Friday close, and we'll see what happens during the day here. But if we go down and lose this tail to the downside, Moderna has got more room to run to the downside. Remember, they just missed top and bottom line, lowered guidance, bad news with Pfizer coming out. It could be a little while before Moderna kind of gets situated, or in this crazy secular bull market, maybe it happens right away. We'll see. The other one two others I wanted to mention in healthcare, West Pharmaceutical Services. Looks like it's starting to trend back down. If it can't hold 400, here's your breakout at about 380. So this is really going to be a key area for me on this stock. Can we hold the 380 to 400 area? And then last up, Danaher, DHR. This one looked like it also printed a hammer. Now this one is getting a little bit better reaction off of their hammer than what we saw, at least initially, with Moderna. So we'll see whether or not we can continue moving up. But I think that 20-day is what you want to watch on Danaher on any bounce there. All right, that's it. Let's get a quick update of the market. Sorry, I ran just a minute over. I'm trying to do better on these earnings beat shows to try and wrap up by 9:30. You can see Tesla, by the way. I didn't even mention Tesla. Elon Musk announced over the weekend that he was looking to sell 10% of his stake in Tesla, and he put it out for vote on Twitter. And basically, the Twitter folks voted in favor of it. I think it was 59% to 41%. They approved him selling 10% of his stake. So that's putting a little bit of pressure here on Tesla this morning. And my gosh, the stock needs a break. It's been up straight up for so long. But Tesla will be under pressure, and that's probably going to have a little bit of a negative impact on the XLY, which it's a pretty big part of consumer discretionary. And then also on the NASDAQ, we'll see whether or not the NASDAQ, which is underperforming on a relative basis, we'll see whether or not that bounces back. But a lot of it will be based on what happens with Tesla. All right, that's it. Appreciate you tuning in. Tomorrow, I will be over at Stock Charts TV at 9 a.m. for your next Trading Places Live. So just go there right at 9 a.m., click on this, and you'll be able to listen in tomorrow. Listen, everybody, have a great day. Remember, check out Earnings Beats. This is a great time, by the way, to come on board for our 30-day free trial to our service because of all the events we have coming up. And I'm telling you, the best special we've ever had at Earnings Beats will start later this week. Everybody have a great day. Be back tomorrow. Happy trading.